Hey traders, this is Blake Morrow with Trader Summit, and with me once again I have Eric B with EPB Macro Research. Good to see you, Eric.
Hey Blake, it's been a while since the last time we talked.
It has been a while, and it's good to see you. And I've been thinking about this. Well, we all have, and I say me, and everybody else that is in the markets. We've been thinking about this move that we've seen in interest rates and how it's really affecting the economy, but more specifically, how it's been affecting the housing market. And I know you've been talking a lot about housing here in the U.S. and I actually wanted to ask you about U.S. and maybe how you felt about housing globally. But let's start with like the U.S. These rate moves that we're seeing out of the Federal Reserve. So, what are your thoughts right now with the U.S. housing market based on what the Fed is doing?
Yeah, so the housing market has been a huge focus of mine for like the last 6 months or so because the housing market is a leading indicator of economic activity. A slowdown in the housing market today generally foreshadows a slowdown in consumer spending, something like 6 months in the future, because of all of the knock-on effects that go into the housing market. You know, when you buy a new home, you need to put new appliances in there, you need to put new furniture in there. That feeds into retail sales, that feeds into manufacturing. So the cycle really emanates from changes in monetary policy, how it flows through housing, and then how it gets to consumer spending. So a lot of people focus on the end of the cycle, the employment, the retail sales, but they sort of ignore what's going on the front end of the cycle or the leading indicators, which would be the housing market. The second important thing to note is that the new construction market is smaller than the existing home sales market. Existing homes that are already built, they're about 85 to 90% of the transaction volume, and the new homes are 10 to 15%. But the new homes are the lion's share of economic activity because you have to build. That's what requires the employment, the
Sure.
construction workers, everything that like that. And what we're seeing in the new construction market is it's pretty alarming. We've had one of the largest increases in interest rates, in rate of change terms, so just how quickly they've increased, almost ever. And what that's done is it's put a significant amount of pressure on the demand for new homes. We can see that in mortgage applications coming down. We can just see it in the volume of new home sales. They're down 51% from August of 2020. And that's caused the month's supply of new homes, again, just focused on the new home market, to rise to almost 11, which is the highest level since 2008. So what does that mean? It means that the home building companies or anyone that's in the new construction market is going to have to slow down their construction, slow down their production. That's going to put pressure through the rest of the economic cycle. It's going to result in less pressure for raw materials and commodities that go into these houses. It's going to result in less employment in the construction sector. And then it's going to feed through ultimately to retail sales, because if you're not buying a new home, you don't have to furnish it. So,
Right.
we're seeing some signs of some, really, really big slowdowns in the volume of transactions. And that's a concern to me as looking out, 6 months for the economic cycle.
So let me ask you this though, and I get exactly what you're saying, but hasn't the dynamics shifted a lot from the work from home, you could call it an evolution, business evolution that we have right now, where you have, people that are seeking employment where they can work at least from home partially. So you have more people that are seeking for, bigger homes. And do you think this is going to be a permanent fixture of the housing market in years to come? Because, I know there's some employers that are requiring people that go to the office, but there's a lot of employers that are being very
Totally.
flexible. And so,
Totally.
and with the lack of building that we're seeing, and we saw after the GFC, or the Great Financial
Mhm.
Crisis, if you will, inventories might still stay low. So what
Mhm.
does that do, and how does that factor into the way you're viewing the market, over the next 6 months, let's say?
Yeah, so there's no doubt that there's probably some increased utility of a single family home versus an apartment or maybe a slightly bigger home because of the fact that everyone may want a home office in there. But at the end of the day, it's just going to come down to what people can afford, right? And what drives the housing market is really interest rates and income, right? Because those are the two factors that feed into demand. And the inventory story is quite interesting. When we look at the new home market, new construction, the best inventory metric to me is the month's supply of new homes. And what that tells you is how many months it will take at the current pace of sales to clear the existing lot of inventory. And a balanced market is about 5. And in the new home market, new construction, that's risen to 11, which
Wow.
is a huge spike, highest
Yeah.
since 2008. However, in the existing home sales market, it's down at 3, which is a really, really tight market, right? Why is that? Well, that's because everyone who had a home refinanced at 2% when interest rates dropped. And now rates have jumped to 625. You're never going to get rid of that mortgage, right? That mortgage is an asset now. So you're not going to list your home for sale because you'll have to trade a 2% mortgage for a 6% mortgage.
Right.
So what's happening is it's causing a reluctance of new listings to hit the market in the existing home sales market, keeping it super, super, super tight. But the home builders, new stuff is coming to market because they're finishing construction and nobody's buying those. So you're seeing a huge rise in inventory relative to sales in the new construction market, and you're seeing a really, really depressed level of inventory in the existing market. It's a dynamic that we've really never seen before, and it's going to be interesting to see how that one plays out.
Yeah, I was going to say, how does that shake out? I mean, like because you're right. I mean, inflation where it's at from a CPI standpoint, if you have a mortgage that's at 2.5% or 2.25% or even sub 3%, why do you want to sell your home right now? I mean, that doesn't make any sense. But so it's going to be so strange as we have like this low inventory, but you're right, the affordability, I mean, I know incomes have risen, but have they risen at the same pace that we've seen this accelerated move in home prices over the last year? So I guess it is going to be a really interesting housing market. And what are your thoughts? I mean, because a lot of people are anticipating some housing crash. I mean, I understand why the housing market crashed last time. And, all you have to do is watch The Big Short. If you weren't in the markets like I was, you can watch The Big Short and you have a good understanding of it. But do you anticipate that we're going to see some big housing crash, or is it going to be a correction? What are your thoughts?
Yeah, so I've written on Twitter about this, and I have some YouTube videos about this topic specifically. So I expect a pretty serious downturn in the housing market. But I expect the downturn to be more severe in the new construction market than the existing market. And when I speak about a downturn in housing, I'm mainly focused on the volume of transactions, because that's what feeds through to economic activity. We have to separate volumes versus prices.
Okay.
Speaking just about volumes, we've already seen, effectively a crash in volumes.
Right. Yeah, transactions.
1%.
Right.
Yeah, basically 50% decline in volumes. That's definitely a crash, right? So that's going to have a negative impact on growth 6 months into the future. It just has to, based on the way it feeds through the cycle.
Yeah.
I don't expect this to be a repeat of 2008, mainly because in 2008, if you take the amount of debt that was in the household sector and the banking sector, it was 220% of GDP. And it's about 150% today. So it's 70% lower, the aggregate debt load in those two sectors. So the risk of a housing downturn morphing into a banking crisis is dramatically reduced. I'm not expecting a replay of 2008 for that reason alone. However, I am expecting the housing downturn to persist into 2023 and perhaps a little bit longer, because the Fed is going to have to remain persistent in their reluctance to ease policy. That's going to keep mortgage rates relatively elevated. And by the time they get around to cutting interest rates, it's likely because the economy is going to be in a recession, which would be negative for income.
Yeah.
So and this is sort of by design, right? They are trying to engineer a downturn in the housing market to cool things off. So how does that translate to prices? Well, volumes lead price. Price is like inflation, home price inflation. And we know that inflation is a lagging economic indicator. So home prices are generally a lagging economic indicator. Volumes are more of a leading indicator. So just on the fact that we've had such a crazy decline in the volume of transactions, it is going to put downward pressure on prices. We're already seeing that. The Case-Shiller index is quite delayed, but some of the more real-time measures are showing, I would say, somewhere between 5 to 8% price declines in the more speculative markets, maybe something like 2 to 4% in the less speculative markets. So it's hard to say exactly where that settles out, but I would expect prices to turn around when volumes turn around, and I don't expect that for the next couple of quarters. So I think that price pressure remains, but I don't think it's going to be a 2008 scenario.
Okay, that's a great summation of like the current environment, and I want to ask you this, and this is kind of throwing you a curveball a bit. I know we're predominantly focused on North American house prices, but have you at EPB Macro, have you done as much research in other markets like European markets and housing markets and how they might be affected, maybe even China as well?
Yeah, I haven't done as much work on those markets, but what I could say is that the economic cycle is the same, whether you're in the US or you're in Canada, in terms of changes in monetary policy, changes in interest rates affect the housing market first. It's the same general sequence, any economy you want to go to.
Yeah.
And every central bank, basically almost like 100% of central banks, are raising interest rates. Everyone's got an inflation problem. So the probability that you have a more global downturn in housing activity and a global downturn in home prices is more elevated. Now, I don't have the numbers in front of me specifically, but the numbers that I cited for the US are what you're going to want to look at for other countries. So the US deleveraged the banking sector and the household sector significantly after 2008, while other countries have not, right? China, for example, maybe Canada as another example. So you want to be looking for countries that have significant debt loads concentrated in the household or mortgage sector and the banking sector, because every central bank's raising interest rates. So it's going to be the same dynamic there.
Wow.
And just for reference, I just wanted to share my screen here and
please
pull
do.
up this chart. This is what I was referring to earlier. I wish I could have put it on the screen as I was talking. This is the month supply of homes in the United States. And the black line is the new home or new construction market, while the green line is the existing home sale market. So you could see what's going on here with just an unbelievable explosion in the month supply of new homes, but a really, really, really tight existing home sales. But we've really never seen a divergence like this. Now, again, the green line represents 90% of the transaction volume. So when people look at the market as a whole, they'll say inventory is really, really tight because the green overwhelms the black.
Sure.
But as far as economic activity, the black is more important than the green because of the construction and the jobs and everything like that. So,
man, I'm going to go out and short copper right now.
Yeah, this is.
I'll be right back. I'm just kidding. I'm joking.
Yeah, no. It's a unbelievably interesting situation,
It is.
and just a tremendous rise in the month supply of new homes. It's a very reliable leading indicator of economic activity because of the feed through to construction and retail sales and everything I mentioned. So this has me on high alert for a more serious slowdown to come in the next couple of quarters. We've been decelerating. The growth rate's been cooling. But data like this tells me that we're actually in the earlier days rather than towards the end of this slowdown.
Okay. So, but as you're talking about this and you're talking about the existing home, single family homes versus the new single family homes, the new ones are going to weigh on economic data globally more than, if you think from a consumer standpoint. If I'm a homeowner, I have, $1 million in equity, and then, my home price goes down, 10% or 20%. I still have a lot of equity, but I'm just not feeling as rich.
Right.
And that could obviously affect consumer spending as well. But when you're talking about new home sales, that's really going to affect, all the way down the line
Exactly.
from our in our economy. That's another interesting point of view that I think everybody needs to take a look at. So
yeah, you make a really great point. So you're referring to the wealth effect, and
yeah.
Robert Shiller, who's famous for the Shiller PE ratio and also the Case-Shiller home price index. He, along with two other authors, wrote a paper on the wealth effect, and their conclusion was that there is almost no wealth effect for stock prices. So when the stock market rises or the value of your stock portfolio goes up, you don't spend any more money. There could be a lot of reasons behind that. It's quite volatile. Nobody really borrows against their stock holdings, at least
Sure.
not regular, average people like you and I. We're not taking margin loans against our equity portfolio. But
Hey, wait a second.
what they margin is different than borrowing against your stock portfolio to buy a car, let's say, right?
Right.
Not a lot of people do that. But what they did conclude was there is a reasonable wealth effect in the housing market. So stock prices rising doesn't affect consumer spending that much. Home prices rising, much bigger effect on consumer spending, both in the positive and negative direction. Home prices tend to be more stable. They don't fluctuate up and down 5% every day. And a lot of people are very comfortable with HELOCs, or borrowing against the equity in their home at what were lower interest rates a while ago. And people see it as a bank account that they can tap into. It's been normalized that that's a very acceptable thing to do. So, when we saw this huge rise in home prices, that everyone had this newfound equity, a lot of people pulled out some of that equity to, go shopping.
Yeah.
They didn't really do that with their equity portfolio. So it is a area of the market that's very interesting and something that we have to track, because home prices really are much more concentrated in terms of this wealth effect as compared to stock prices.
I can relate to that, just being in the housing market that I live in, and I know you're very familiar with some of the hot markets here in the United States as well.
Mm-hmm.
So that's great. Now, I want to ask you one last thing before we let you go, because we talked a little bit about interest rates. Here we got the Fed. People everybody's talking about the terminal rate and where the Fed's going to end up at, whether it's 4.25, 4.5. Maybe even 5%. Some people are even forecasting 6%. But they believe that, I think the common misbelief or misconception is the Fed raises rates and then, economic activity slows to a point where they can just start cutting rates again. Are you in that camp? Do you believe that the Fed's going to, wherever you believe the terminal rate might be, but do you believe the Fed will just automatically start lowering rates to spur economic activity? Or do you think they're just really going to try to keep rates higher for a longer period of time, and to really constrict that economic activity, that inflation genie that is been let out of the bottle? What are your thoughts there?
Right. So personally, I believe that the Fed hasn't gone too far yet, but I think that the expectations have moved too far in terms of how much it's going to damage the economy in 2023. And the reason I say that is because I track leading economic indicators. And leading economic indicators are squarely in recessionary territory. So what that means is, even if the Fed stopped tightening monetary policy today, I still believe that the economy would trend into a recession. But they're not going to stop today. They're going to raise rates, maybe another 150 basis points in the next 3 months here.
Yeah.
So I think that they're going to put much more pressure on economic activity than they believe. And some of the leading indicators of inflation have already started to come down, and some of them aggressively so. Now, it's coming down from an elevated level. So that doesn't mean that, the first sign of inflation ticking down, they should cut. But we have to remember that these policies have variable lead times. So in my view, they are going to raise rates, and they're going to probably hold rates too high for too long. And I think that the risk here is that they generate a more significant downturn than they may believe at the moment. So that's my concern.
All right. Well, Eric, I'm glad you voiced your concern. You got an opportunity to do it here. And remember, if you're watching us on YouTube, and Eric, we're going to talk about your YouTube channel here in just a second. Make sure you give Eric a big thumbs up, subscribe to the channel so you don't miss any of this exclusive content at Trader Summit. But Eric, I love your work. I love your new videos that you've been putting out, and you touch on real estate specifically, and some of those got my attention. Can you tell us, as if this is the first time for some reason I'm hearing about you, how do I follow your work?
Yeah, so you can follow me on Twitter at EPB Research. I'm pretty active there. Or on YouTube, just type in the search bar EPB Macro Research, and all my videos will come up. We're doing about 1 or 2 a week now, so there's a lot of good content on there.
It's great. I'm truly enjoying your stuff, and I've enjoyed your work for many years now. I've been able to work with you here on Trader Summit, and I appreciate that. And if you're listening at home, make sure you appreciate Eric as well by give him a big thumbs up there. So Eric, let's catch up soon, and I hope we can. And I want to thank you for spending your very valuable time with us.
Awesome. Thanks, Blake.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.